Nicholas Darvas, a name synonymous with extraordinary market success, was not a seasoned financier or an academic economist. He was, remarkably, a professional dancer whose journey into the world of stock market investing began with curiosity and culminated in one of the most astonishing financial feats of his era. His story is a powerful testament to the idea that financial mastery isn't reserved for those with Wall Street pedigrees, but can be forged through rigorous self-education, unwavering discipline, and a commitment to developing a systematic approach. His path, initially fraught with the common pitfalls of novice investors, ultimately led him to devise a strategy so elegant in its simplicity, yet so profound in its effectiveness, that it transformed a modest capital into a fortune. It is a narrative that continues to inspire, proving that with the right mindset and a well-defined methodology, anyone can navigate the complexities of the stock market and achieve remarkable results. Darvas's unique background, far removed from the daily cacophony of the trading floor, ironically provided him with the necessary detachment to observe market behavior without succumbing to the emotional biases that often derail even the most experienced traders. His commitment to understanding the market on his own terms, rather than relying on external noise, set the stage for his groundbreaking discoveries. Darvas's initial foray into the stock market was, like many beginners, marked by a chaotic and often frustrating experience. He plunged into investing, relying heavily on the prevalent advice of the time. Tips from brokers, rumors circulating in social circles, and the so-called hot picks that promised quick riches. This unstructured approach, devoid of any personal system or analytical framework, inevitably led to a string of losses and deep disappointments. He quickly realized that blindly following the crowd or acting on unsubstantiated whispers was a recipe for financial disaster. This period of trial and error, however, was not without its merits. It served as a crucible, forging within him a profound understanding of what not to do. It highlighted the critical necessity of moving beyond the realm of speculation and developing a robust, systematic strategy rooted in objective observation rather than subjective opinion. Darvas recognized that if he were to succeed, he needed a method that was entirely his own, one that he could trust implicitly, independent of the often misleading advice of others. The unique demands of his profession as a touring dancer further intensified this need for an independent system. While traveling the world, often performing in different cities every night, he was geographically distant from the bustling financial centers and lacked immediate access to real-time market data. This constraint, which might have deterred many, became a catalyst for innovation. He couldn't sit in a broker's office, listening to the latest gossip or watching the ticker tape continuously. Instead, he relied on telegrams, often receiving delayed price updates. This forced him to distill market movements into their most essential components, to focus on the significant trends rather than the daily fluctuations. It compelled him to think in terms of clear, actionable signals that could be communicated and acted upon remotely. This remote access, or rather the lack of immediate access, was a blessing in disguise. It shielded him from the psychological pressures of minute-by-minute market noise, allowing him to develop a detached, analytical perspective that would become the cornerstone of his revolutionary strategy. His system had to be simple enough to be communicated via telegram, yet powerful enough to capture significant market moves. It was in this environment of forced simplicity and systematic thought that the seed of the Darvas Box strategy began to germinate. He understood that superficial information, often abundant and easily accessible, was rarely profitable. True insight lay in identifying underlying patterns and acting on them with precision and discipline. This realization was a turning point, transforming him from a reactive gambler into a proactive, systematic investor. He learned that the greatest advantage often comes not from more information, but from a clearer interpretation of the information that truly matters. From his unique vantage point detached from the daily frenzy of the stock market, Darvas began to observe the natural rhythm of stock prices. He noticed that after a stock made a significant upward move, it would often enter a period of consolidation, trading within a relatively narrow range before either continuing its ascent or reversing course. These periods of consolidation, he realized, formed distinct price boxes. This observation was the genesis of his revolutionary Darvas Box concept, an idea so simple yet so profoundly effective that it changed his financial trajectory forever. He meticulously defined these boxes with clear, objective rules, eliminating any room for subjective interpretation. The formation of a Darvas box begins with a stock reaching a new price maximum. Following this new high, the critical observation is that for 3 consecutive trading days, the stock's price does not exceed this new maximum. This 3-day consolidation below the peak precisely defines the upper boundary of the newly formed box. This upper limit acts as a psychological and technical resistance level, representing the price point where selling pressure temporarily matches or overwhelms buying pressure. Simultaneously, the lower boundary of this box is established at the lowest price point reached during this period of consolidation. This represents the support level where buying interest is strong enough to prevent further declines. The beauty of this definition lies in its clarity and objectivity. It's not based on arbitrary lines or subjective feelings, but on verifiable price action. Imagine a stock rising, hitting $50, and then for the next 3 days it trades at $49, $49.50, and $48. The $50 mark becomes the top of the box. If during those 3 days the lowest it touched was $48, then $48 becomes the bottom of the box. This box then acts as a clear visual and analytical framework. The upper limit of the box serves as a crucial resistance level. It's the ceiling that the stock price has struggled to break through, indicating a temporary equilibrium between buyers and sellers. A decisive break above this upper limit would signal a significant shift in this equilibrium, suggesting that buyers have regained control and are pushing the price higher. Conversely, the lower limit of the box functions as a strong support level. It represents a floor where buying interest has historically stepped in, preventing the stock from falling further. A break below this lower limit would be a bearish signal, indicating a weakening of the stock's upward momentum and potential for further decline. By defining these boundaries with such precision, Darvas transformed vague price movements into actionable insights, providing a clear map for when to enter a trade and, crucially, when to exit. This systematic approach removed guesswork and emotional decision-making, replacing it with a logical, rule-based framework that could be consistently applied across different market conditions. His ability to distill complex market dynamics into such a simple, repeatable pattern was a testament to his observational prowess and his unwavering commitment to objective analysis. The Darvas Box strategy, while deceptively simple in its core concept, is underpinned by several critical principles that Darvas meticulously developed and adhered to. These principles, when applied with discipline, form a powerful framework for identifying high-probability trading opportunities and managing risk effectively. First and foremost is the selection of stocks. Darvas did not chase every stock that formed a box. His focus was exclusively on strong, growing companies, those that exhibited fundamental strength and were often leaders in emerging industries. He sought out companies with accelerating earnings and revenue growth, innovative products, or those benefiting from significant industry trends. While primarily a technical trader, he understood that sustained price appreciation required a solid foundation. He used elements of fundamental analysis not to determine intrinsic value, but to identify the potential for growth and to ensure he was aligning himself with companies that had genuine momentum and market interest. He looked for stocks that were already demonstrating strength, often trading at high price-to-earnings ratios, which indicated market excitement and anticipation of future growth. This selective approach ensured that when a box breakout occurred, it was often backed by underlying business strength, increasing the probability of a sustained upward move. He wasn't interested in turnaround stories or undervalued gems. He wanted companies that were already showing signs of market leadership and investor enthusiasm. This selective filter was crucial, as it helped him avoid weak stocks that might form boxes but lack the inherent power for significant breakouts. He understood that strong companies attract strong buying interest, which is essential for momentum to build and sustain. The signal to buy is perhaps the most straightforward aspect of the strategy. A buy signal is generated precisely when the price of an action decisively breaks above the upper limit of a newly formed box. This breakout signifies that the resistance level has been overcome, and buyers have asserted their dominance, pushing the price into new territory. It's a clear indication that the stock is ready to continue its upward trend. However, Darvas added a crucial layer of confirmation to this signal. This brings us to the principle of volume confirmation. A breakout above the box's upper limit is not sufficient on its own. Darvas insisted that this price action must be accompanied by a significant increase in trading volume. This surge in volume acts as a powerful confirmation, indicating strong institutional interest and widespread buying pressure. It signifies that the breakout is not a fluke or a minor fluctuation, but a genuine and robust move supported by substantial capital. Without this increase in volume, a breakout might be a false breakout, a brief push above resistance that quickly fizzles out, trapping unsuspecting buyers. Darvas was meticulous in this regard. He would avoid entering a trade if the price barely exceeded the previous maximum on low volume, as this often signaled a lack of conviction behind the move. High volume on a breakout validated the strength of the underlying trend and the commitment of buyers. It was his way of ensuring he was joining a movement that had serious momentum behind it, rather than just a minor ripple. He understood that volume is the fuel that powers price movements, and a breakout without it is like a car without an engine. Perhaps the most critical and non-negotiable aspect of the Darvas Box strategy is risk management and the strict adherence to stop losses. This principle is the bedrock upon which all his success was built, protecting his capital and allowing his profits to compound. Darvas understood that even the best strategy would fail without robust risk control. An initial stop loss is placed immediately upon entering a position. This stop loss is strategically positioned slightly below the lower boundary of the current box from which the stock has just broken out. The rationale is clear. If the stock fails to sustain its breakout and falls back into or below the previous box, it signals that the breakout was false, or the upward momentum has stalled. In such a scenario, the trade premise is invalidated, and it's imperative to exit the position quickly to minimize losses. This initial stop loss acts as an immediate safety net, limiting potential downside risk from the outset. It removes the guesswork and emotional agony of deciding when to cut a losing trade. The rule dictates the action. The ingenuity of Darvas's risk management truly shines with his concept of trailing stop losses. As a stock continues its upward trajectory and forms new, higher boxes, the stop loss is systematically adjusted upwards. This is a crucial mechanism for protecting accumulated profits and allowing winning trades to run without risking a complete reversal of gains. For instance, if a stock breaks out of Box A and then forms a new Box B at a higher price level, the stop loss is moved up from below Box A to just below the lower boundary of Box B. This process is repeated as the stock climbs through subsequent boxes, Box C, Box D, etc. This trailing stop loss ensures that Darvas continuously locks in profits as the stock advances. It embodies the core trading philosophy of letting profits run, while simultaneously protecting capital from unexpected reversals. It transforms potential paper profits into realized gains, ensuring that a significant portion of the move is captured. Exiting a position is as rule-based as entering. There are two primary triggers for exiting a trade. The first is if the price of the stock, after a breakout, returns into the previous box. This indicates a failure of the breakout and a potential loss of momentum. The second, more definitive trigger is if the price breaks below the lower boundary of its current box. This is a clear signal that the upward trend has likely ended, and a reversal or significant consolidation is underway. In either case, the stop loss is triggered, and the position is closed without hesitation. Darvas's unwavering commitment to these stop-loss rules, even when faced with the temptation to hold on in the hope of a recovery, was paramount to his success. He understood that emotional attachment to a losing trade is one of the quickest paths to financial ruin. His system was designed to remove emotion from the equation, ensuring that losses were always small and manageable while profits were allowed to grow substantially. This systematic approach to risk management was not merely a safeguard. It was an active component of his profit-generating strategy, ensuring that capital was preserved for the next high-probability opportunity. So the Darvas system offers a clear, logical path to success in the market, proving that discipline and objective rules can work wonders. It's a ready-made plan of action. But if you want to move beyond the how to the why and dive into the very essence of the psychology that drives the markets, then you need to study the life of his legendary predecessor, Jesse Livermore. His story is the ultimate lesson in how a trader's mind works. There is no better way to absorb these lessons than through Edwin Lefebvre's classic book, Reminiscences of a Stock Operator. This isn't just a book, it's a portal into the mind of a genius. To turn his experience into practical tools, the chapter-by-chapter analysis by Max Davidson is indispensable. It treats each of Livermore's trades as a business case study, showing where strategy triumphed and where emotions brought ruin. This is your chance to learn from another's million-dollar mistakes. Studying Darvas gives you a system. Studying Livermore gives you wisdom. The link is in the description. Beyond the mechanics of identifying boxes and setting stops, Darvas repeatedly emphasized that the true differentiator in market success lies in discipline and the psychology of trading. He recognized that the market is a powerful arena for human emotions, and without strict emotional control, even the most robust strategy can be undermined. He understood that the human psyche is inherently wired to make irrational decisions when money is on the line, driven by primal forces like fear, hope, and greed. Emotional discipline was, for Darvas, the bedrock of consistent profitability. He meticulously documented how fear would tempt him to sell winning positions too early, locking in small profits while the larger trend was still intact. Conversely, hope would often cause him to cling to losing positions, rationalizing that the market would eventually turn around, only to watch small losses balloon into catastrophic ones. Greed, the intoxicating desire for ever greater returns, could lead to overtrading, taking on excessive risk, or deviating from his established rules in pursuit of a quick, massive gain. Darvas learned through painful experience that these emotions are the trader's greatest adversaries. He actively sought to neutralize their influence by strictly adhering to his predetermined rules, allowing the system rather than his feelings to dictate his actions. He understood that the market doesn't care about a trader's emotions. It simply reflects the collective actions of all participants. A detached, objective approach was his shield against the psychological traps that ensnare so many. He would often say that the market is designed to relieve the impatient of their money and reward the patient. The importance of neuchilnehodotrzymania własnych prawill. Unwavering adherence to one's own rules cannot be overstated in Darvas's philosophy. He cautioned vehemently against the dangers of following hot tips or succumbing to the wisdom of the crowd. His early losses had taught him that external advice, no matter how well-intentioned, often leads to confusion and suboptimal decisions, because it lacks the personal conviction and systematic rigor that only an individually developed strategy can provide. He believed that each trader must forge their own path, develop their own system, and then trust that system implicitly. Once rules are established, they must be followed without exception. Any deviation, no matter how minor, introduces subjectivity and opens the door for emotional biases to creep back in. His success was a direct result of his unwavering commitment to his own methodology, even when it felt counterintuitive or when others offered seemingly more enticing alternatives. He understood that consistency comes from adherence, not from constant adaptation based on fleeting market sentiment. A cornerstone of his learning and refinement process was the keeping of a detailed journal of transactions. This was not merely a record-keeping exercise. It was a powerful tool for self-analysis and continuous improvement. In his journal, Darvas meticulously recorded every trade, the entry point, the exit point, the reasons for entry, the stop-loss placement, and most importantly, his emotional state at the time of the trade. By reviewing this journal, he could objectively analyze his successes, identifying what worked and why. Crucially, he could also dissect his mistakes, understanding where he deviated from his rules or where his emotions led him astray. This rigorous self-examination allowed him to refine his strategy, strengthen his discipline, and build a deep understanding of his own psychological vulnerabilities. The journal served as his personal mentor, providing invaluable feedback that no external advisor could offer. It was the laboratory where he continuously perfected his craft, turning every trade into a learning opportunity. He often said that the market teaches you lessons, but only if you are willing to listen and learn from your own experiences. Finally, the enduring maxim that guided Darvas was the principle of cutting losses quickly and letting profits grow. This isn't just a catchy phrase, it's a fundamental tenet of successful trading that he embodied. His strict stop-loss mechanism ensured that losses were always small and manageable, preventing any single losing trade from significantly impacting his capital. He understood that protecting capital is the first rule of investing. Conversely, his trailing stop-loss system allowed him to ride winning trends for extended periods, capturing substantial profits as stocks moved from one higher box to the next. He never capped his upside potential, understanding that truly exceptional returns come from allowing winners to compound. This philosophy stands in stark contrast to the common beginner's mistake of holding on to losers in the hope of recovery and selling winners too soon out of fear of losing paper profits. Darvas's genius lay in his ability to implement this principle with unwavering discipline, letting his system dictate when to cut and when to hold, thereby maximizing his overall profitability. This simple yet profound principle, rigorously applied, was the engine that powered his incredible financial ascent. The application of this remarkably simple yet profoundly disciplined strategy transformed Nicholas Darvas from a professional dancer with a nascent interest in the stock market into one of the most celebrated and successful investors of his time. His financial journey is a testament to the power of a systematic, rule-based approach, demonstrating that extraordinary results are achievable when one combines keen observation with unwavering emotional control. The numbers themselves speak volumes about the strategy's effectiveness and Darvas's unparalleled discipline in its execution. He famously managed to convert an initial capital of a mere $25,000 into an astounding $2 million in a period of just 18 months. This incredible feat, achieved without the benefit of modern technology or immediate access to market information, solidified his place in financial history and proved the enduring power of his method. His groundbreaking success, achieved through a strategy that ran counter to much of the conventional wisdom of his era, naturally garnered significant attention. To share his insights and methodology with a wider audience, Darvas penned his iconic book, How I Made $2 Million in the Stock Market. This book quickly transcended its initial publication to become a timeless classic in investment literature. It wasn't merely a recounting of his trades. It was a detailed exposition of his thought process, the evolution of his box theory, and the crucial psychological lessons he learned along the way. The book's clear, direct, and practical language resonated deeply with readers, offering a refreshing alternative to the often complex and opaque theories prevalent in financial circles. It demystified the stock market, presenting a clear, actionable framework that aspiring traders and investors could understand and implement. To this day, How I Made $2 Million in the Stock Market continues to inspire countless individuals, serving as a powerful guide for those seeking to navigate the complexities of the market with logic, discipline, and a systematic edge. Its enduring popularity is a testament to the universal applicability of Darvas's principles and the timeless nature of his insights into market behavior and human psychology. The book remains a beacon for anyone who believes that financial independence is attainable through self-reliance and a well-defined strategy. Despite the passage of decades and the dramatic evolution of financial markets with the advent of high-speed trading, sophisticated algorithms, and instant global communication, the Darvas Box strategy remains remarkably relevant and effective for today's traders and investors. Its enduring power lies precisely in its core tenets: simplicity, objectivity, and a profound understanding of price action and market psychology, which are timeless elements of trading success. For traders and investors who are seeking a systematic approach, the Darvas Box offers an unparalleled framework. It removes the subjectivity and emotional guesswork that often plague individual investors, replacing them with clear, actionable rules. The strategy provides definitive signals for when to enter a trade, a breakout above a box on confirming volume, and crucially, when to exit, a break back into a previous box or below the current box's lower limit. This systematic rigor allows traders to execute their plan with confidence, knowing that their decisions are based on objective market data rather than fleeting emotions or external noise. In an era of information overload, the Darvas Box cuts through the clutter, focusing only on the price and volume action that truly matters for identifying momentum. Moreover, its simplicity and clear rules what make it exceptionally accessible for a wide range of market participants, from seasoned professionals to absolute beginners. Unlike many complex technical indicators or intricate algorithmic strategies that require deep mathematical understanding or specialized software, the Darvas Box can be identified and implemented with basic charting tools. The rules for defining a box, identifying buy signals, and managing risk are straightforward and easy to comprehend. This accessibility means that individuals who are new to trading can quickly grasp the fundamental principles and begin applying them, building their confidence and understanding of market dynamics without being overwhelmed by complexity. For experienced traders, it offers a robust, time-tested method for identifying momentum plays and managing risk with precision. The fact that a strategy developed by a dancer in the 1950s, using telegrams for market data, still holds such profound utility in the 21st century's hyper-connected markets is a powerful testament to its fundamental soundness. The Darvas Box is not a magic bullet, but a proven methodology that empowers traders to approach the market with discipline, clarity, and a systematic edge, continuing to build fortunes for those who master its simple yet powerful principles. It reminds us that sometimes the most effective strategies are not the most complicated, but the most consistently applied. Please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well.